Hey there, Bookkeeping Side Hustle community. It's Kate. So glad to be back with you for our second in this installment of our series about debits and credits. Today we're calling this one, oh shoot, I didn't change the graphic. It's not Debits and Credits Made Simple.
Oh.
This is Debits and Credits Advanced Bookkeeping Scenarios. I'll change that in a second. To tickle your fancy today though, y'all, we're gonna talk, I'll tell you some of the things we're gonna talk about. We're gonna talk about accounts payable, accounts receivable, clearing accounts, and especially how those impact the balance sheet. We're going to learn how to catch your mistakes. So this is all advanced stuff, and you're going to need to have a solid understanding of what we learned about in our first episode last week, which is actually called Debits and Credits Made Simple. And if you haven't watched that, I'm going to connect it in YouTube after we're done streaming here, and it's going to be popping up in your screen. It'll also be linked below, and you can also get all of my resources that I do with Acadian at bookkeepingsidehustle.com/Acadian. But if you haven't watched that one, you're going to be totally lost. So you've got to know how she teaches. You got to know these fundamentals first before we get into this heavier stuff.
Yes. Do not start with part two.
Do not start with part two. This is part two. We are going to have some handouts that include some cheat sheets about prepaid expenses, depreciation, external payroll providers, equity transfers, and purchases made with a loan. Those will be downloadable as well. Same spot as everything. Yeah, so
we're gonna do hands-on practice.
Well, we'll do Margie's famous hands-on practice, which there was a moment last week when I said my jaw hit the floor. It was a big loud crash because my jaw hit the floor because of how impressed I was with just how she delivers the training and with the clicking around, and you get the instructions while you're clicking. It was amazing. Always hands-on practice with Acadian. So I'm going to let Margie say hello, and then we're going to get right into it because we have got a lot we want to cover. And so Margie, glad to have you back.
Yeah, thank you. I'm delighted to be here. This is, I love this topic so much. Oh, good. We got
I changed the title. I'm in a hotel room, y'all, too. So I got my camera here, but my computer here. I'm on an ironing board. My eyes might be kind of looking weird, but I'm definitely here with y'all. Margie, we know who you are. You did a lot of intro in that last section. Shall we jump right in?
Let's do it. Let's jump right in. So I need to share my screen. There we go. Excellent. So last week in part one, we talked all about debits and credits, how it works, why it works the way it does, which is the most important thing, right? Because so many people just try and memorize it and then they get lost. And so what we talked about is why it is the way it is, and to help you get it really deeply understanding that. Okay. So make sure if you don't have that solid, go back and watch that. But everything we talked about cash basis accounting. So now we're going to move into accrual, okay, which means that in order to see the full financial picture of the business, you have to include future stuff, not just stuff that's in hand, but future stuff. So in business and in life, there are some expenses that we incur before we have to pay for them, like your utilities, your medical expenses, whatever. And then when we sell something, sometimes we sell it before we actually collect the money. Okay, so in that case, you would send an invoice and the customer pays later. Okay, so what we're going to talk about first is the expenses we incur before we have to pay for them. Now, the total of these incurred expenses is recorded in an account called accounts payable. And because it's something we owe, it's money that we owe, it's a liability. And you learned last week, where do liabilities live? They live on the credit side. That's where a place that money comes from, okay? Now, money is added to that accounts payable account when a bill is recorded in QuickBooks Online. Now, I'm most familiar with QBO, so I use all QBO terminology. And, Kate, I'm sure there's different terminology in FreshBooks, but in QBO, we're talking about something an expense that you incur that you then pay later. Okay, so here, go ahead.
I was just going to say the biggest, people literally swap the meaning and they use the word invoice. They say, I received an invoice. But if you're the business owner, invoices for money coming into you. And just understanding those nouns alone is huge. It's huge. And being super strict with how they use them. If I hear anyone that I work with use them incorrectly, I actually say, stop. You meant a bill. You didn't get an invoice. You got a bill. You sent an invoice.
Yeah. Excellent. So last week we had this scenario. Last week we talked about how if you bought something and you paid for it with a credit card. Well, now instead of buying something and paying for a credit card, we simply buy something and owe that money to a vendor. So instead of owing it to where we have to pay on the credit card, now we have to owe that to a vendor. So it's really the same thing. So we have an expense that increased, and expenses increase on the left side. We have a liability that increased. So we have and liabilities increase on the right side. We talked last week about how increase and decrease can be confusing. So if you just in your brain can think about, is there more or is there less? So there's more expenses and there's more liability. Okay, so that's what you're going to see in the debits and credits when you record a bill. Now, money is going to be subtracted from that accounts payable account when that payment is recorded on that bill. Okay, so let's take a look at our scenario. So last week, we talked about paying the credit card with a check. Well, now instead of paying the credit card with a check, we're simply going to pay that vendor with a check. Okay, so it's the same thing. So there's less liability. The liability decreased. So that means it goes on the left. The checking account, that is the check that you paid that comes out of an asset. Assets live on the left-hand side, but there's less money in your checking account. So now it's moving over to the right-hand side. So we have that little crisscrossy thing. Okay, so the balance sheet is going to show the current total amount owed to vendors, and you'll be able to see how money is added to and subtracted from that account. And here's where we're going to do our famous hands-on practice. Let's actually see this in action. Okay. All right. I'm just going to
put the worksheet. Should I put the worksheet in the chat?
The first exercise, how bills affect accounts payable. Okay. So we're going to actually walk through this together. Okay. So we're going to start by loading the sample company. And again, like the reason we use QBO is just because they give us this free playing stomping ground, our sandbox, where we can actually see this in action. Okay. So we're going to click here to load the sample company, and I'm going to hold my breath to make sure that it works because, technology.
Voila.
All right. Here I am in the sample company. Okay. And we talked about this last week that when we have all of our exercises are created in Scribe, and Scribe has an extension that you can add to Google Chrome so that when you click this Guide Me button and you have the sample company open, this is when Kate's jaw hit the floor last week.
Yes.
She was like, wait, what? So
which tree is this?
Yes. Right, exactly. It's this is what I always say, magic happens. So when you do that, and last week we provided, and on the where do you have the link where it's bookkeepingsidehustle.acadian, right?
Yep. bookkeepingsidehustle.com/Acadian. I can put that in here. I'll actually put it on the video as well right now.
Yeah. So we actually gave you instructions on how to load that Chrome extension. So you can also be doing this. Now, when you do that, it automatically turns on Guide Me mode, which means that you have to click next to go through every step. And I don't like Guide Me mode, so I always like to turn it off. Just going to click that button. So now let's go ahead and we're going to practice this. We're going to see this in action. Okay. Last week, Kate talked about like closing your eyes and guessing what you're going to see on on the journal entry, right? So that's what we're going to do. Okay. So on the left navigation bar, we're going to click, hover over create. We're going to click bill. Under vendor, we're going to select Brosnahan Insurance Agency. We're just going to say that the terms, this is the amount of time that you have to pay. That's the terms. We're going to just change that to 30. I don't know why we added that into the exercise. It doesn't really matter, but here we go. And I'm going to just change the amount here to $250. Okay. And I'm going to click save. I don't want to click save and schedule payment because I'm not getting ready to pay this bill. I'm just logging it so that we have a record of what the company still owes. Okay, so I'm going to click save right now. That's going to allow me to stay on the bill for a minute so that I can check that transaction journal. So I'm going to put you on the spot, Kate. I did this last time and you got a little nervous, but I'm sure you got this now.
Yeah.
What do we expect to see when we look at the transaction journal underneath?
We just created an accounts payable.
Yep.
So the debit will be to expense and the credit will be to the liability account, accounts payable.
Exactly. So let's take a look at that.
A 6,000 level expense account and the 2,000 level liability account. Does it give the account numbers?
No, we don't have account numbers.
Okay.
Okay. So you're exactly right. So accounts payable, that's a liability. It lives on the right-hand side. On the right-hand side, when it increases, when there's more there, it's a credit. And the insurance, which is the expense account, lives on the left-hand side. There's more expense. So now it has added more to that debit. Okay.
We have decreased our profits, right? So that's decreasing our profits because it's showing up on our P&L. The expense
part, yes. The expense part is, yes. Good. All right. So now let's pay this bill and see what happens. Okay. So now we're going to hover over create. We're going to select pay bills. There are, by the way, there's tons of ways this is not a class in QBO. There's a ton of ways to pay bill, to record bill payments. This is just one of them. Okay. So we hovered over pay bills. Next, we're going to click the box next to Brosnahan Insurance Agency. Okay. Under payment account, we want to make sure and select checking. All right. And we're going to click this arrow next to schedule payment, and we're going to hit save and close. Okay. So now
in QBO, if you put the schedule payment, that's assuming that there's some sort of payment processing tied to that account. Like you can actually use QBO to move money around, but the default is not going to be that your clients have QuickBooks payments set up.
They have to sign. Yes. Thank you for the clarification. You do have in QBO, you have to sign up for a QBO payments, or QB payments is called, in order to actually move that money.
Yep.
Otherwise, you're just recording whether it did or not. Okay. All right. So now we're going to go back. Now what we have to do, what we want to do is we want to do the same thing that we did with the bill. We want to look at the bill payment and see what happened. Okay. So in order to do that, I have to go find that bill payment. It's not as easy as just looking at the bill itself. So I'm going to go hover over expenses right here. And then I'm going to go to vendors. I'm going to click Brosnahan Insurance Agency. And I'm just going to close these for our purposes here because this just gives us some more real estate here. Okay. So here you can see the bill that we created that was $250. And then here's the bill payment that it shows as a negative because it took it out of accounts payable. Okay. So we are going to, so here's just what I said. Okay. So we're going to click on this bill payment. Now, before I take a look at the transaction journal, let's predict what should we see there. Okay, so we just paid a bill with a check. What should we see?
You should see a a debit to the accounts payable because we have less that we owe someone, but we also lost money in checking. So we're going to credit our checking account.
Right. So it's that crisscrossy thing. Okay. So let's look at the transaction journal. And here it is. Okay. So again, so accounts payable, that's a liability, but there's less money in it. So it's on the debit side. And the checking account is an asset, but there's less money in the asset. So it's on the credit side. Yay. A+ for Kate.
I like getting A+. What I was going to say is like what we're doing, like, you know, as your students are taking, I know you have lots of courses like this. We're just doing this free show. So because it's so, we believe that it's important. This is like one of the most important things I believe in. Step one of earning a right living as a virtual bookkeeper is making sure you know accounting fundamentals really well. And I've been saying that for like 7 years. Like it is the number one thing. But what I was going to say was like, eventually, you don't need to go find the bill payment and click the bill payment and open the journal entry. Like you're going to stop doing that eventually. Once it's become second nature, we're just diving. I would say we are about as deep inside QBO as like one can be whenever you hit that show me the journal entry button. And so this is like a learning exercise. This is, again, you're saying you're not teaching how to do QBO. This is not how you would be a bookkeeper. This is how you would check yourself if you get knotted up. It'd be how you look for what clients have done wrong. If you're like, what the heck? Well, let's go see the actual journal entry, and that's going to really open your eyes. That's what I do often. But this is really deep in. This is really deep in because we are learning. We're learning T accounts right now. We've just put the T accounts are checking and accounts payable, and we've just drilled down into what journal entry is affecting those T accounts. So just a little commentary on like, don't be scared that you think, well, heaven's sakes, it takes 5 minutes to record a bill and a payment. No, eventually it takes 10 seconds.
Right. We're teaching, we are teaching you the fundamentals. We're teaching you what's happening under the hood so that you know, so that you have a deep understanding of how it all works. Okay. At this level, we're not teaching you actually how to be a bookkeeper. Okay. So now let's take a look at the balance sheet because we want to see what happened just now when we paid that bill. Okay. So to get there, we're going to click over reports. We're going to go to standard reports. We're going to select the balance sheet. Here I am on step 20. And I'm going to close all my pop-ups because QBO loves pop-ups. All right. So I don't know if you have that problem in FreshBooks, but
and they're always right where you want to click too.
All right. So here we are. Here is our accounts payable account. And in QuickBooks Online, in any report that you're looking at, you can click on the number to see what transactions made up that number. Okay, so I'm going to do that. I'm going to click 1602. Okay, and I'm going to scroll down to the bottom for the most recent thing. And you can see here is the bill that was created. And so $250 was added to accounts payable. And then when we paid the bill, $250 was subtracted from accounts payable. All right, now let me go back to this. Not now. How do I do this guy? Okay, the balance sheet will show the current total. All right, so here's the important thing that you need to know. All right, so we already said accounts that when the payment is recorded in QBO, that means it's going to be subtracted from accounts payable. So what else does that mean? Oops, we already did that. Wait, hold on. All right. The important thing is this one right here. That's what I was trying to say. Is that accounts payable should never be a negative number. You can see why that is, right? And you can see how that would happen, right? If you see a negative number in accounts payable, that means that people are recording payments, but they're not recording the initial bill, okay? Or they're not connecting them together, okay? So, so this is, and yes, this is a real thing that happens.
Oh yeah.
Is that they pay something and they say they don't understand what accounts payable account is, and so they record it to the accounts payable account instead of that. Okay. All right. So we have been talking about expenses. Okay. Now let's shift our focus and talk about the opposite. Okay. So we've been saying, okay, the business incurs an expense that they have to pay later. Now let's say we are sending an invoice to somebody and they have time to pay us later. Okay. So when customers have not yet paid, they owe us money, and the total amount of that money is recorded in an account called accounts receivable. Now, in accrual accounting, we consider that money ours, even though we don't actually have it in our hot little hands. Okay. Mm-hmm. It's still considered ours. Okay. And because it's something we own, it's an asset. Okay. So it's treated like an asset. And just like with accounts payable, money is added to the accounts receivable account when an invoice is recorded in QBO. So, just like before, okay, so with the example we used last week was you sold something for $250 and deposited it into your checking account. Well, instead of depositing in your checking account, now the customer owes you that money. But a checking account is an asset and accounts receivable is an asset, so it's going to behave the same way. So you've added revenue, okay, so that increases, it lives on the right-hand side. You're adding to an asset that lives on the right-hand side. And so that's what you're going to see. Now, when the customer pays that, then when the customer pays it, then the money is subtracted from that accounts receivable account. Okay. So previously we used the example, your customer paid $250 via ACH. Oh, no, sorry, this is the same example. Okay. So if the customer pays, okay, then they add that money is added to the asset increases, okay? But it also, in the accounts receivable world, the asset of accounts receivable decreases, and that means it's going to go over on the right-hand side on the credit side, okay? So they're both assets, but there's one on each side because one's increasing and one is decreasing, okay? Now, the net effect on the balance sheet is zero because both the accounts receivable account and the balance sheet both the accounts receivable and the checking account are on the balance sheet. So it's just moving from one place, just moving from one asset to another asset, okay? And by the way, we're not going to go through this like we did with accounts payable, but I did provide an exercise where you can see, just like we did with accounts payable, you're going to see all of these different steps only with accounts receivable. Accounts receivable has a little bit of an extra hiccup though, which we'll talk about in a second. But Kate will drop, I don't know, it's on the, since we're not going through it now, I mean, it's on the Acadian Pay, the bookkeeping side hustle. Right. Okay. So just like accounts payable, accounts receivable should never be a negative number. Okay. So if you see an accounts receivable number that's negative, what does that mean? I'm going to put you on the spot here. Or anybody, we've got a couple people in the chat. If you see accounts receivable that's negative, what does that mean?
They have been adding. Can you add a payment to an invoice in QBO, but not have recorded it? Or like, are you calling it like a sales receipt?
They've recorded it. Yes, they've recorded something to accounts, directly to accounts receivable, instead of doing the correct workflow of creating so the invoice adds it, and then the payment subtracts it. Okay. So they've been adding a payment without connecting it to an invoice. They've been adding a payment and just saying, oh yeah, this is it's accounts receivable. So this happens. People are like, what they do is they use a deposit. They use a deposit form.
A deposit.
So we got this money. Yeah. So they got this money. They deposited it in the bank, and the account where they said, oh, where did it come from? It comes from accounts receivable, because they don't know what they're doing. They don't know how this works. They don't know what it's supposed to be.
I thought you were going to say that accounts receivable, maybe more frequently, would grow like infinitely, because
that also can happen.
They're not applying payments to invoices. They're recording them. They're recording the income, but they're not saying that particular dollar that showed up in my checking account was for that invoice that was $1.
Yes. Yes. That also happens, but that doesn't result in a negative number on accounts receivable. And so you're not going to necessarily catch it when you're looking at the balance sheet. True. So yeah, very good. Now, here's how it becomes a little tricky with accounts receivable, because when you receive money from the client, or the customer, when does it actually arrive at the bank? Well, it entirely depends. If in the example that we just used, the payment went directly to the bank, like it was an ACH and there was no middleman, it just went right there. Okay, but then you'll see it right away. But more often than not, it goes to some intermediary place. Okay, so in QBO, we have an account called undeposited funds, or sometimes it's called payments to deposit, but it's like this temporary holding place where the money goes. This is for cash and checks, and then later gets deposited. Or if it's going through some kind of a third party place, then they're going to have, that's going to be another holding place. And then the fees for that are actually going to come out of that. Okay. Yeah. So the money is subtracted from accounts receivable when the payment is recorded. And then in those other two scenarios, it's going to be added to a clearing account, not to the checking account, like we just talked about. Okay. Yeah. Again, I don't want anybody to get lost. This is all in the practice exercise that we don't have time to go over today, but you're going to be able to see how all of this works. Okay. So your customer paid instead of your customer paying via ACH, which went directly into the checking account, now we're going to say your customer paid with a check, which means it's going to go into this holding place. Okay. So the check is not going into the checking account, but it's still going, that holding place is still an asset, because it's still the stuff that you own. Like, even if it's an envelope stuffed with cash, that's still an asset. Okay. Even though it's not a checking account. So that's going to behave the same way. Okay. So this is all of the same, but then we're going to have, and the net effect on the balance sheet is 0. But now we're going to have some different behavior if several things are going into the clearing account before the money is actually deposited to the bank. Okay. So the money is subtracted from the clearing account. So we add to the clearing account, and then it's subtracted when it's deposited to the bank. Okay. So I might have a bunch of different payments. They're going to go like in an envelope, and then together they're all going to go into the bank in one deposit. Okay. So here you deposited 3 checks totaling $750 into your checking account. The checking account is an asset. Okay. So that increased. And the asset that is your clearing account, okay, that also has $750. That's going to decrease. Okay. So we've got still assets on both sides. And the net effect on the balance sheet is 0. Now, here is the other troubleshooting thing that you were kind of alluding to with accounts receivable, and that is if money goes in, it has to come out. So if we're talking about undeposited funds, it has to come out. If we're talking about some other like third-party clearing account, like a PayPal or Stripe or something like that, money has to come out when it's actually deposited into the bank. And here's another thing for troubleshooting that you can look at is are these accounts that are constantly being added to, are they also being subtracted? Okay. And if they're not, then there's some kind of a workflow problem or something that's not being that's not being addressed. Okay. All right. Now I'm going to shift gears. We're going to talk about journal entries. Did you have any other comments here about this part?
I was going to say FreshBooks calls it money in transit.
Yes.
Is the concept. And so undeposited funds is just a unique QBO term for a general concept called a clearing account. It's just a specific name called undeposited funds, right? So you can rename these things. You can be very specific. You can call it like Cashbox clearing, Stripe clearing, PayPal clearing. But I know that whenever Veronica Wasik has her diagnostic review program, like checking undeposited funds is like a huge way as you're like assessing how messy some books are, and those negative AR and negative AP is like a huge tell that you got problems and they need to pay you a lot of money to fix them.
Yes, exactly. Huge tell that they're not doing something right. Yeah, good. All right. So there are times when QBO transactions are not enough to record what needs to happen I have a typo there. What needs to happen in the books. Okay. Now you should always use, and this is true for all software. I'm sure Kate will say the same thing about FreshBooks. You should always use, if the software has an option to do it, you should always use the software options. Okay. Because that's going to include all of the relevant information. When you can't, that's when you use a journal entry. A journal entry records the debits and credits of a transaction directly into the books. Now, a thing that I always tell my bookkeepers is that accountants will tend to use journal entries for everything, and it will drive you crazy. But that's just the way it is. Like they will just do that. They're just trying to do things quickly. They know how it's supposed to work under the books. But
maybe.
Oh, yes, exactly. They don't always know.
A lot of bad journal entries being made out there. Anyway, keep going.
Yeah. So why don't we use journal entries for everything? Like, why don't we just use that and forget the software? Well, here's some reasons why. It's overdue invoices. The software can send reminders for that. The reminders there'll be invoices that are still open after the payment. Undeposited funds will just have a lump sum. It won't have the broken out individual cash and checks that were deposited. If you've got inventory, then the journal entry doesn't affect the journal entry counts, and it doesn't calculate sales tax if you're doing it that way. Okay, so you always want to make sure that you're using QBO transactions or whatever whenever possible. Okay, so what are some times that you would use? What are some times when you would use journal entries? Okay. So one is prepaid expenses. Now, this is another handout, Kate, if you want to pass that. I mean, you don't have to put it in the chat because it's on the page. It's all on the page, right? Yes. So, so we've given you, so we have 3 handouts for today. One is the accounts payable exercise that I walked through with you, okay? Then the accounts receivable exercise for you to do on your own time. And that goes into much more, you get to see every single transaction journal from the whole process including it going through undeposited funds. And then we have a cheat sheet. So those two are exercises.
Is that one called practice, Margie? Is that one called the practice together, the AR and the AP?
Practice together is accounts payable.
Okay.
Practice on your own is accounts receivable.
Okay, I'm gonna update that. Okay.
And then the third one is just a cheat sheet for how to do these more complex journal entries. Okay. So they are, prepaid expenses. That's, for example, if you paid an annual subscription for something, and then but you don't want to recognize the expense. You don't want to recognize the expense, say, like when you paid for an annual subscription in January, you want to spread out that expenses throughout the year. Okay. Depreciation, which is when you buy a fixed asset and it loses its value over time. You want to reduce the cost. You want to reduce the value of the asset and increase the expenses when that happens. If you have external payroll providers that don't connect with QBO and they just give you a report and you just have to go in and enter the numbers, that would be a time for journal entry. Equity transfers. So if you have to move money around between partners, for example, this is a big one. If you purchase something with a loan, I don't know why this isn't in QBO already. If you purchase it any other way, it's already in QBO. But if you purchase it with a loan, then you have to set up the loan via a journal entry. All righty. So let's take a look at that handout.
I put the specific journal cheat sheet handout, y'all, right in the chat too, for those y'all watching live. It'll be again on our regular resources as well. Yeah. Yeah, keep going. I don't know what I was going to say. Something about the last bullet on your journal entry page, but just keep going.
Oh, okay. All right. All right. So what I've given you on this handout is the when you would use it, what to do, and how to remember what the debits and credits are. Okay, when this happens. Okay, so we just talked about prepaid expenses. You would use this when you're ready to recognize part or all of a previously paid expense, like monthly rent from an annual lease, or like I said, a subscription to something that you like spread out over the length of the subscription. So you're going to credit the asset and debit the expense, okay, when that happens. So an asset, typically, remember, lives on the left-hand side. That's a debit, but the asset is decreasing, and so that's why it's on the credit side. And the expense is increasing. There's more expense, so that is on the debit side.
Do you recommend people using the like in this example? Oh no, those aren't numbers; those are dollar signs. Let's say it was like a $1,200 annual subscription to something, and so you want to recognize $100 a month. Do you recommend the recurring feature so you don't actually have to make that journal entry every month? You put all 12 in at once. Okay.
Yeah, for sure. You can do that. Yeah, you can do that for something that the amount is always the same.
Yeah.
There are other things you can't do it for because the amount isn't always the same.
Right. Like payroll.
Yeah. Or depreciation changes. Right. So So unearned income is the opposite of that. So if someone pays you for an annual subscription, but you're providing the service, throughout the year, so that's unearned income. And you're going to see that's just exactly the opposite. So you have a deferred revenue account, which is not money you get to keep. Like, this can be confusing for business owners because we're like, I got all this money, and we're like, but you didn't earn that money yet. So we can't recognize that until later. So anyway, so that's the opposite. We also have payroll account. This is something you have to like really wrap your head around with when it comes to payroll, is like, what is actually the employer expense? What is Like when we are collecting taxes from the employee, we're just doing that as a benefit. We're being nice to them. It's not really it's not our money, it's their money that we're doing. And you have to really wrap your head around like what is actually the employer expense, what is employee expenses and liabilities and all that stuff.
Acadian has a very detailed payroll training too, right? Don't y'all have
There's two, yeah. So we address payroll in two different places. We have a QBO payroll companion course. Those are for people who want to pass the QBO payroll certification that's in your Pro Advisor Academy. And then inside Bookkeeping Fast Track, which is our foundational course, like everything that I've been talking to you about in the last 2 weeks has really been out of the Bookkeeping Fast Track, because that's the place where we talk about this is where we dive deep. This is where we dive deep into all of this stuff. And there's a whole payroll module in there that really helps you, again, wrap your head around so you understand what the different liability accounts are, how they're used, garnishments, like all of that stuff. So so Acadian addresses that in two different places.
Payroll's
just like everything. What's that?
Yeah. Payroll's really hard. I still have trouble getting my head around certain things about, like, especially when people are small guys, and a lot of people are like doing their business and they fund a lot to their solo 401ks, and they don't really set it up right, and they like don't move the money, but they like tell the payroll company that they are, because they're gonna like, well, I set it up with Fidelity, and I'm like, but your payroll's with Gusto, and I feel like every year, especially at the end of the year, I get new learning / beating with payroll.
Yeah. Just like so many other things, like inventory is another one where like some bookkeepers are like, I am never going to touch that. Some people are like, I do not touch payroll. That's not my thing. I do not touch inventory. That's not my thing. And then other people are like, bring it on. Like we both know a payroll person who like she dove head first into payroll because no one else would. And she's like, oh, this is my jam.
I would say at the same time, like I've avoided inventory. I think you can successfully avoid inventory, even if you're not, whatever this phrase, I don't do payroll. Like I don't run people's payroll. But it hits me hard at the end of the year. Like I have to have their statements, like their financial statements need to say like, well, you told Gusto you had $100,000 salary. Like, is that what the wage line on the P&L says? And so I don't run payroll for anybody. Heavens no. But
you still have to make the impact.
Is gonna has to understand, like you said, like that tax withdrawal is not. There's no category called tax expense. It is employer taxes, and the rest of that is the person's wage.
And that's why we dive deep into it in Fast Track is because of exactly that. Is like, even if you're not in charge of payroll, it affects you, and you have to understand what all these accounts are and how they work and why they exist and how to reconcile them. That's another thing we make sure that you know how to do. So anyway, well, we can wrap up, but because they have the document here that talks about like one of the a big one here is the sale of an asset. You really have to know all the journal entry and all the good stuff for how to calculate that, because that's a big one. So anyway, you can stop.
Awesome.
What's that?
This has been awesome. I was going to say, if anyone who's currently watching live, there are a handful of y'all here, have a question, go ahead and ask it now. Otherwise, Margie and I are wrapping up. If this has been beneficial to you and you are kind of already here, but you have a friend who needs that 101 lesson, that debits and credits made simple lesson, make sure you grab that and keep. There's no shame in starting there. I know a lot of your students, Margie, say like, I have like 2 full whole degrees, 2 grown-up degrees in accounting, and I still need to remember this stuff because all I've been doing was like plugging in people's W-2 information into 1040s. So it's been a while, and so you forget which way they move, and you forget that you kind of have to move your hand. I don't know. Maybe it's because my husband's a pilot. I'm always doing like
Yeah.
Which is going up, which is going down, because he talks with his hands too. But you have to know that. So I want to make sure. Yes, I'll put the website that will take you to all the resources, bookkeepingsideschool.com/Acadian, AKADAIN. There is also a discount code, an evergreen discount code that will be there on that page. Go to that page to get that discount code. Currently, it's a 15% discount off all of her courses. If that changed, it'll be the best place to get that discount code. Investing in your education is critical for this type of industry, y'all. We can't think of this as I can just click around on my tablet while I'm watching my daughter do gymnastics. Like there's a lot more to it than that. And Margie and I both, like, I think that's how we ultimately connected, was just our belief that, like, I remember specifically, it was like, Margie, don't tell anyone, but I'm an advanced pro advisor. I don't know anything. And then there are people who are really, really good at QuickBooks and accounting, and they can't pass that test. And I'm like, and I just am good at tests. And so and you're like, kind of like, I get it, like samesies, like, just because who cares? Like, those credentials are fine, but we need that foundational knowledge. And that's where this is. And it's, I know that you are hoping that there's going to be more sample companies and different softwares that allow you to do that hands-on practice, because that is critical to, like, y'all's mission. Like, until someone builds a good sample company, you're going to stick with that teaching in QBO. But, like, the point, the debits and credits and the T accounts are the same no matter what software you use. And so learning in QBO is not a bad skill at all to have. So, like, you're going to get good at QBO while you're learning these basics as well, and that's not a bad path to take. So I appreciate you. What other courses do you have coming up? I know you have the fast track as the fundamentals. Cleanup courses, all the certifications.
So we think of all of our courses as in phases. So phase 1 is where you are just laying the foundation, you're getting your business set up. So in phase 1, that is bookkeeping fast track. That is the laying the cornerstone. That is the main thing. But then also in phase 1, we can help you get your QBO certification. We can help you get your Intuit bookkeeping certification, and we can help you get your new CAS Foundation certification from Intuit. And then phase 2 is once you actually lay the foundation and you know, like, how actually bookkeeping works and why, now it's time to actually practice the software. So fast track is not about learning. We use software, but it's not about learning the software. Now we're going to move into a phase where you're actually going to learn the software, and you're going to learn it in the same way astronauts learn how to be in space. You're going to go through simulations. It's the way that your husband learned how to fly an airplane, right? He went through simulations. So we put you through a full year. That's not a calendar year, but it's a full year of actually being a bookkeeper for a fictitious business owner.
Right.
And you're actually, it's like a day in the life of the bookkeeper. You sit down and you process the transactions, and throughout the year you get really solid knowledge of all of the tricks and features of QBO. It's QBO focused. And then here in phase 2, we're also going to help you get that QBO level 2 certification, which is super easy once you've gone through all of that. And then the QBO payroll we consider that a phase 2 course. And then phase 3, once you have the fundamentals, once you have that practice, now it's time to step out and actually learn the real money-making skill of cleanup. So our cleanup course is where you learn how to do a diagnostic review, how to price your services, how to actually communicate with the client so that they understand why your proposal is what it is, like why it's so expensive and why they should sign up for it. We teach you all of those communication skills, and then how to actually do the cleanup quickly and easily. I always say that if you hired me to come cook you a gourmet meal, which I would love to do because I love to cook, and I walked in your kitchen, And it was a mess. There was no counter space, and the sink was full of dishes. Well, I can't even do my job. I can't even do the job that you hired me to do until I first clean up the kitchen. And so we teach you how to price that cleanup so that that's out of the way, and then you can get on to doing your monthly delivery services. So
awesome.
That's our approach, and everything we do, like you've said, is all hands-on. We don't teach you anything that you don't actually get to practice, because you can't learn how to ride a bicycle by watching a YouTube video. you have to actually do it. So, and that includes cleaning up a full set of books when you're in phase 3. Yeah.
When you're in phase 3, you have a messy file.
We have a whole, we have a final project.
Yes.
We have a final project where they price it. They do a proposal on it. They clean it up. Yep.
Awesome.
Yeah.
Everyone, the bookkeeping side of the community is free, and I just hang out and interview smart people and write a Substack newsletter. So all those resources to connect with me, again, are below. Thank you for listening to these lessons. Please keep spreading the word, everybody. And Margie, that these fundamentals are really the starting place. So we have excellent bookkeepers out there in America helping the strong businesses that need our help. So
yeah.
We will wrap up now, and we will almost assuredly have you back, Margie, I'm sure. Adios now, everybody. Bye.
All righty.